financial markets in turmoil.
What are the root causes of the financial crisis?
The dollar losing value.
Heading for its biggest loss in nearly 3 decades.
Will Social Security even be there?
I don't know.
Buy or rent?
That's a very good question.
Interest rates.
I'm not so sure.
Where do you put your money?
I don't know.
Welcome to the show that answers your questions. This is Follow the Money Weekly with your host, economist, and best-selling author. Here's Jerry Robinson.
All right, friends, welcome to you all around the world. Welcome to Follow the Money Radio. So grateful to have you here along for the ride. As you heard, my name is Jerry Robinson, an economist and author, investor, and founder here at followthemoney.com. And I want to welcome you to episode number 434. Today's episode title, March Madness, an update on the markets in 2023. Well, today we won't be talking about basketball and March Madness, but we will be discussing the latest economic news and how it's been impacting the financial markets. So March is pretty much over now as I'm doing this podcast episode, but it has been a particularly eventful month, with many major economic announcements and developments that's been affecting investor sentiment and leading to big market movements. And of course, one of the purposes of this show is to keep our listeners informed so they can make informed investment and trading decisions. So let's just dive in and explore the madness of March that's been playing out in the markets. So let's begin with a quick recap of what's been going on in the economy lately. And in March, as I mentioned, we saw some pretty big news stories making waves in the financial world. One of the most important financial stories over the last month has been the collapse of several U.S. banks. So we saw the collapse, of course, of Silicon Valley Bank earlier in March, which was, one investor called a hysteria-induced bank run caused by venture capitalists. We have to agree. This was, in many ways, one of the very first bank runs that was inspired by social media panic. It was the biggest bank run we've seen since 2008. The Washington Mutual Bank collapse, of course, was the biggest in U.S. history, back during the 2008 financial crisis. But Silicon Valley Bank was the second largest banking failure that we have seen in U.S. history. And so it obviously raised major concerns about the stability of the U.S. banking system. And then those fears quickly spilled over into the rest of the financial market amid another bank failure. That was Signature Bank, that was shut down. That was the third largest that we have seen in history. So the second and third largest bank failures coming in the month of March 2023. So how about that? And of course, it obviously has to do with the incredible spike in the federal funds rate due to the Fed's constant interest rate hike campaign that it's had going on. So this led to fears of systemic risks and other perceived risks, and it led the federal government to take aggressive action, very aggressive action, in fact. They closed down Silicon Valley Bank, they closed down Signature Bank, they seized their deposits. The Treasury Department, the Federal Reserve, the FDIC, all announcing extraordinary measures in an effort to contain the growing fallout. So let's just briefly talk about what happened there, because now the banking sector, while still fragile and while still concerning, the government has really kind of pulled out all the stops to create a sense of certainty and to prevent a crisis of confidence, which is really what they're concerned about. So first, the FDIC unveiled a plan to protect all of its depositors, fully protect all the depositors of Silicon Valley Bank and Signature Banks. And that plan makes all depositors whole, even those with balances above the standard $250,000 FDIC limit. So, this is moral hazard galore, where you're really dealing with now the idea that the FDIC will backstop a bank if it goes under. And it's important, if they deem it to be, important to the overall system, then they're going to go beyond the FDIC limit. Okay, so this should allay concerns that the FDIC is not going to protect or honor its FDIC insurance. Not only did the FDIC honor its insurance with a $250,000 limit, it went beyond that and made all of the depositors whole. Well, this, on one hand, worked to soothe the fears and concerns in the U.S. economy and the banking sector in particular, but it also comes with this moral hazard. And if you're not familiar with moral hazard, in essence, it's the idea in economics. It's kind of, again, kind of a geeky term that's used in economics, but it's the idea where someone lacks an incentive to guard against risk because they'll be protected from that risk, or they won't bear the full cost of that risk, or they'll be protected from its consequences. And so this is really what we're concerned about, is that we've created a sense of moral hazard here, although they've certainly stopped or stemmed the fears of more bank runs through their policies. Okay, so the FDIC did this. Then the Federal Reserve relaxed its lending requirements through its discount window. So in essence, what they did there was they made it very much easier for banks to get liquidity through the discount window through the Fed. And they also announced a new $25 billion bank term funding program that provides one-year loans to banks with much, much easier terms than usual. And then there was an official statement put out by the Treasury, the Fed, and the FDIC that attempted to downplay the bailout narratives. Of course, this was a bailout of depositors, but they don't like that narrative, of course. And so they put out a statement that said, quote, "No losses associated with the resolution of Silicon Valley Bank will be borne by the taxpayer." Okay, so they're trying to allay the fears or the concerns that they're just moving back to their bailout strategies that they've usually used. So why didn't we see more fallout from the banking sector? Why, because there were many people saying, well, we're going to see many more bank failures immediately, and it's going to lead to systemic risk. Well, why didn't that happen? Well, as we just pointed out, the Federal Reserve, the Treasury, the FDIC pulled out all the stops, and they didn't just bail out the banks. That was not the only thing that assured investors. So too, investors rightly understood that the Federal Reserve's own aggressive interest rate policies had actually pressured the financial sector to the point of massive bank failures, right? So in other words, the Fed's own policies of raising interest rates at this historic level, at this historic pace, basically led to much of the pain in the banking sector. And we won't get into all the details. I mean, it's pretty boring unless you're really geeky and you get into banking finance and the tax laws and all of this. But in essence, these companies, whenever rates began to rise, it created great pressure in their balance sheets. And so you really can point to the Federal Reserve and say they are really a major reason why we had problems in the banking sector. It's almost ridiculous. It's almost ironic in this fact. Now, what this meant, though, was that investors were able to then see, well, if the Fed created these banking problems through their own policies of higher interest rates, and they don't want to aggravate this problem more, what might they do? Well, what they might do is lower their expectations of another, huge Fed rate hike, and also slow down the train on more incoming rate hikes. And so that's exactly what happened, right? So we'll talk about the Fed's latest rate hike in just a minute, because that's another major thing that happened in March. But basically, expectations were lowered. I mean, running into this banking, running into this banking crisis, investors had expected, possibly a terminal rate, a top rate on the federal funds rate of around 5.5%, maybe even a little bit higher, right? They were preparing for that. And that's why the market was kind of convulsing and trying to deal with, where are rates going? How much higher are they going to go? And it was putting a lot of uncertainty into the system. But after this banking crisis and after the reaction of the Fed to it, investors rightly assessed that the Fed's kind of got itself into a pickle here, right? So it's going to have to unwind its tightening program that it's been doing, constantly raising interest rates. It can't go much further. It's beginning to break the system, right? So, in other words, investors are once again increasingly expecting the Fed to pivot away from higher interest rates amid that financial turmoil that occurred in the banking system. And the Fed, as I've said on many occasions over the last several months, is truly stuck between a rock and a hard place. If they keep lifting interest rates in an effort to bring down inflation faster, official inflation, then they risk aggravating an already weakened financial sector. But if they do, pivot to a pause and cut strategy in the near future, in order to unwind some of the damage to the financial sector, they fear a loss of credibility, and then they could even stoke more inflationary pressures as a result. So it's not a good day to be a Federal Reserve policymaker, right? It's a tough job. And even the bank itself, I mean, should it really exist? If you've read my book, Bankruptcy of Our Nation, you know what we think about the Federal Reserve. I won't, repeat it here, But you can read in the book, what we think about the Federal Reserve. It's certainly not been good for the United States overall on the whole. There are better ways to do it. Anyway, that's not the topic of today's broadcast. Okay, so obviously the banking situation was a bad deal. Then you had Jerome Powell's big 2-day semi-annual testimony on monetary policy that he gave last month, or this month. It's still at the very end here of March. And Mr. Powell testified before the Senate Banking Committee, and then he also testified before the House Financial Services Committee. And we got lots of grandstanding from lawmakers during the testimony, many of them asking him, when are you going to stop raising interest rates? And so there was a lot of pressure on Powell there. People were watching that very closely, looking for clues. He seemed to indicate that they were going to keep raising interest rates even more, but was a little reticent to get too strong on that. Then we also had, number 3, we had this big February U.S. jobs report that was released. And you may recall that the official U.S. unemployment rate fell to 3.4% in the month of January, which was the lowest since May of 1969. Well, that's like nearly a 50-year low or so, And so the market expectations in February that we got just a few weeks ago were expecting about 3.4% on the official unemployment rate. That actually edged up to about 3.6% in February. So that actually worked well in the Fed's favor, showing that unemployment is rising a bit more. That's actually what the Fed is desiring in somewhat of a perverse way. They have been desiring to see unemployment rise to show that their Fed tightening program, interest rate tightening program, is working. Okay, and so we did get a little bit of a tick up in the unemployment rate in the month of March, based upon the February jobs report. Then, I'm telling you, we had a lot of stuff happen in March. It was nuts. Then we had the February CPI inflation report that was released on March 14th. Now, back in January, we saw the official U.S. inflation rate was around 6.4% year over year. Well, in this latest report we got on the inflation rate, we saw it eased for the 8th consecutive month, and it fell to 6% year over year in the month of February, which was well below January's 6.4% rate. And February's inflation print, by the way, that 6%, was the smallest annual increase since September of 2021. And it was right in line with analyst expectations. So month over month, even though U.S. inflation ticked up by about 0.4% and core CPI rose about 0.5% on the month, you still had the deceleration of the overall annualized inflation rate. So even though we're still rising in some ways on a monthly basis, the rate of increase has been falling. We call this disinflation. So whenever inflation is slowing, it's not raging, but it's actually slowing, well, then that's where you have disinflation. Now, 1 or 2 economic data points alone don't make a trend, but we now see clear evidence from the prior 8 months in a row of this data, that the Fed's aggressive rate hikes are having their desired effect as official U.S. inflation rates continue to cool at a steady pace. And we would hope so. You think about what the Fed has done here, raising interest rates at the current pace that they have. If you go back to before they began the rate hikes campaign, that they launched back in 2022, the interest rate was near zero. It was like 0.07 or something silly, And then, by the time we've got where we've gotten to now, the Fed has basically raised that interest rate from practically zero to all the way up to near 5% now. And when you look at that on a percentage terms, you're talking about an increase of more than 5,000%, 5 or 6,000%. That's insane. So we've seen an incredible increase in interest rates. And if you've been trying to buy a house, or if you're borrowing money, you've certainly seen how crazy this is. And then, of course, if you are saving, you've also seen, slowly but surely, your savings rates go up. And so, it's kind of nice to have that also. So it's kind of got some good things and some bad things mixed in. But, when you look at the inflation picture across the board, it's still pretty tough. Shelter costs, which we refer to as housing costs, those are remain stubbornly elevated. And they were the dominant factor in the February monthly CPI increase. Consumers are getting some relief, though, in the form of lower costs for energy. We've seen energy prices really plummet. I mean, crude's trading, was trading in the $60 range, the 60s, which is, we haven't seen that for a while. I mean, remember, U.S. crude oil was trading up at $130 last year, right? So that was brutal. We've seen that get cut in, practically in half, over the last several months. And so that's been good to see. It's taken some pressure off of the inflation rate. So we've certainly seen lower costs for energy. That's also translated into lower costs for utilities, which is good news for everybody. Used cars, which were, outrageously priced throughout the pandemic, are now seeing declines, and they're coming back to earth. That's good news. Even medical care has seen some decreases, which may surprise folks. I'm actually seeing some relatively lower costs there. So energy costs are falling. Food costs are still rising. They're up nearly 10% year over year. So the grocery store is still, you're still seeing, very elevated prices. And the same thing goes for housing costs, right? They're up about 8% year over year. But used car prices, as I mentioned, they're down 13 some odd percent over the last year, year over year. So that's, good news. And even though medical services, as I mentioned, medical care is up slightly, like 2% year over year, it fell last month. And so that's good news. When we had this report come out, you saw the financial market stage a pretty big rally after that inflation report, which was led by these oversold bank stocks that had really been hit. And so while the official inflation rate remains historically elevated, it continues to recede, and that's good news for everybody. Okay, so there we had that. Then finally, after all these other things that went on, then the Fed had a meeting, and the Fed's March two-day policy meeting was held on March 21st and 22nd. And at that meeting, the Federal Reserve decided to lift its federal funds rate target by 25 basis points. It raised it to a range of 4.75% to 5%. They usually raise it to a range as opposed to a specific number. And that's the highest level that we've seen the federal funds rate target hit since 2007, right? And when you hear that, you think to yourself, well, that's not a good year because that was the year right before the 2008 crash where they had to lower rates. Well, now you're learning why they raise rates so that they can lower them. And then, of course, they lower them. Why? So that they can raise them, right? So this is the lever that the Federal Reserve has and the control that it has over the economy. So the Federal Reserve continues its war on U.S. price inflation of its own making, by the way, which we know why the inflation went out of control. It was out of control because the Federal Reserve left interest rates at zero, and then Washington began piling in tons and tons and tons of freshly printed money in the middle of the pandemic, okay, in response to the coronavirus. And so, all this money gushing into the system, people being mailed checks by the government, all this money supply rising, and yet the interest rates were just zero, still zero. So you're just stoking massive inflation. Well, the Fed said, well, we're going to wait until the inflation rate gets well above 2% before we do anything. Well, it sure did. It started rising, and then the Fed finally got the hint that it needed to start raising rates. It was scared to do so, fearing that it was going to hurt the economy. And so then they had to play catch up. So then they started all of these big, 75 basis point rate hikes month after month after month. And it was, devastating to asset prices and many other things as well. And so now we've had the Federal Reserve raise its benchmark interest rate for the 9th consecutive time with this latest 25 basis point rate hike. But that was right in line with market expectations. Now, if you go back before the banking crisis that came earlier in March, well, investors and analysts were like, well, the Fed's going to raise another 50 basis points. And the Fed was signaling that it was going to raise another 50 basis points. But the banking crisis caused the Fed to take its foot off the pedal a little bit here and only raise by 25 basis points. Now, even though we've been through this, wild time where we had years of 0% interest rates, and then we had the largest round of monetary stimulus in world history, and then the price of everything began to spiral out of control in 2022, and then the Fed's been playing catch up in an effort to rein in the price inflation that it created through its ill-timed policies. Well, it does appear that the Fed is close now to the end of its rate hike cycle. And this is based upon the Fed's own updated, what they call dot plot, from its newly released summary of economic projections, which suggests that the Fed will hike interest rates just one more time in 2023 before ending its inflation battle. So in other words, the Fed is projecting one more rate hike with a terminal or peak rate of 5.1% this year in the federal funds rate. So we're talking about maybe another 25 basis point rate hike before the Fed then does what? What are they going to do after that? Well, they're going to pause. They're going to pause apparently around the 5% level, or 5.1% level or so, throughout much of 2023 is what they're saying. The Fed envisions a series of interest rate cuts spanning through 2024 and 2025 with an expectation of a 2.5% long-term target rate. That's their plan. But if you look at what investors are expecting, they're not expecting that. They're expecting the Fed to begin cutting this year. Now, the Fed says, no, we're going to probably cut next year, right? No, investors are looking ahead and saying, no, the Fed is very likely to not just pause for a month or two, but then to begin cutting rates this year. And we agree. That's been our expectation as well. We expected a pause to be reached likely in Q1. It looks like the pause is going to come in clearly in Q2. And we expected that rate cuts could begin as early as Q3. And we think that's very likely. In fact, we could get the very first rate cut in Q2, possibly, like maybe toward the end of it, right? So these are all, by the way, current market expectations, and they're flexible, right? So you got to realize that these things evolve as the economic data points evolve. And it's trying to make predictions about what's going to happen is virtually impossible, especially with the potential of a black swan. You could have something else go wrong that you just don't know, right? And there's obviously lots of problems that could go wrong. There's lots of things that could really go wrong between now and, say, the end of this year even. But with that said, all things being equal, we do see that the Fed is very likely to begin cutting rates this year, right? Also, one more point here from the Fed summary of economic projections. The Fed is forecasting a revised GDP growth rate of a mere 0.4% this year. I mean, it's barely above zero. So in other words, the Fed is expecting the United States economy to grow, the GDP, the total output, to grow by a mere 0.4% this year, 2023. It's pretty crazy. And then based on these newly revised projections, the Fed also expects the economy, the GDP growth rate in 2025 to be 1.8%. That's not great. Right? That's not great at all. And a 4.6% unemployment rate. So in other words, the Fed expects a restoration of economic normalcy within 2 to 3 years. But that economic normalcy is pretty disastrous. I mean, if you have a GDP growth rate that's less than 2% and you're piling on debt and you have trillion-dollar deficits every year, that's completely unsustainable, right? Of course, that's completely unsustainable. So anyway, so now that we've covered some of the key economic news of the month, I want to talk about what investors can do to adjust their strategies in response to these ongoing developments. I mean, one of the most important things to keep in mind as an investor is you need to stay diversified. And this latest sell-off, this grinding, terrible bear market that hit in 2022 really offered a lot of opportunity for those who maybe haven't been taking advantage of investing, or maybe haven't really been, dollar cost averaging in. I mean, the pullback in stock prices across the board was pretty vicious, but some, high quality companies got hammered, and they've already rebounded. Some of them have really rebounded. I'm thinking of companies, that like in the tech sector, for example, that have really seen their prices rise back higher, in recent months. But again, one of the most important things to keep in mind right now is that there's so much uncertainty, there's so much volatility in the markets, and even though it's been easing, it's important to keep your investments spread out across different asset classes and sectors. We've talked about this for years. So we talk about it in our book, Bankruptcy of Our Nation. We talk about it on our website, followthemoney.com, for our members. We're constantly teaching you the importance of minimizing your risk, protecting your portfolio from potential losses by, prudent decisions. And while on one hand, you're going to be trading, you may be a trader out there listening to me, even all of you traders need to have a long-term investment plan. Like, you need to have a plan where you have money that you're dollar cost averaging into high quality assets that you're going to use later on down the road. Trading is an activity that you would do maybe around your investment portfolio. It's an activity that you can do to generate income, in the near term. But when it comes to overall investing, trading is not investing and investing is not trading. Now, again, this podcast is not about the difference between these things. I've talked about this many, many times, but this is the thing to keep in mind here, is that while this has been a wonderful time to be able to speculate and trade with these markets so haywire, it's also been a great time to dollar cost average into high quality assets and to be spread out and to take advantage of this opportunity. And another strategy that you really want to focus on, in my opinion, is to stay focused on the long term. It's so easy to panic and make, sudden movements in your portfolio. You can start, saying, well, I'm going to sell the stock, or I'm going to do. Well, oftentimes, if you make long-term investment decisions based upon short-term market movements, it can end up doing more bad than good for you in the long run. So you really want to maintain a long-term perspective. You want to have some investment goals set out. If you don't have investment goals, you need a financial advisor, right? Or you need to make those investment goals. But to me, it's always best to have a financial advisor that kind of gives you an x-ray or a second opinion of your current strategy. If you don't have a financial advisor, you need a financial advisor. We work with a team of financial advisors. You can go to our website, followthemoney.com/advice. And there you can just fill out a really quick online form, and we will put you in touch with a financial advisor that gets it, right? Not somebody, who is just pushing products all day long, but instead who approaches this from a holistic, perspective. And that's who we work with. So if we can ever be of help to you, don't hesitate. Followthemoney.com/advice. The worst case scenario is you get a second opinion on something and, you say, well, I'm doing just fine. Well, then that's great. But a second opinion never hurt anybody. So anyway, you really want to make sure that you're keeping your mind focused upon the long term and making decisions not based upon short-term market movements for your long-term portfolio, right? And then also, you do want to stay informed. You want to watch those charts. If you're an investor, you want to take advantage of those pullbacks. If you're investing in a high-quality company and they get hit, in the short term on some, just some sort of volatility, or just some news story that's really immaterial to the long-term fundamentals and growth of the stock or the company, well, then that's a great opportunity, for you in the near term. So that's something to keep, for the long term, I should say, that you want to keep in mind. So you want to be proactive. Take a proactive approach to your investments. Stay informed. And one of the ways our members do that is by, being a member here. We provide a lot of ongoing insights. I provide a daily email that goes out to all of our members every day with a new idea, not only a trading idea, but also, education. We do weekly video calls where people can learn ongoing education and all of this. You need that. You really need that to stay in the game. All right. So now that we've talked a little bit about some of those strategies, we've covered some economic news that happened in March. We talked about some of these in strategies we can take. Let's just take a quick look at some of the market trends that are currently happening right now. And as I mentioned, March was a particularly volatile month for the financial markets. We saw a lot of significant fluctuations in different markets. But let's just talk about some of the key trends that we see right now that will help you as you're looking out at the market landscape. So I want to look at several markets. Let's begin with the S&P 500 because this is really the most important global measure of the U.S. equity market by both domestic and foreign investors. You typically find that 3 out of 4 stocks in the U.S. will move in the direction of the trend of the S&P 500. So it's very important to pay attention to. And the S&P 500 has really been range-bound for a long time, quite frankly, many, many months. But it is beginning to look as if it's nearing a breakout moment to where it can really begin to push higher and then push to new highs over time. So it's beginning to look pretty positive. Right now on the near term and also the intermediate term, we see uptrends, right? Right now, the long-term uptrend is not there. It's almost there. We're very close to forming a new long-term uptrend in the S&P. And when we do, of course, we're going to alert our members. That's a big, meaningful moment. The same thing with the NASDAQ 100. The NASDAQ 100 has been fighting in a range-bound motion, but it just recently here at the very end of March began to push higher and is fighting right at its February highs. At the very beginning of February, the NASDAQ 100 was up at a pretty interesting area. Well, we're right back there now here at the end of March, and it looks like we're going to try to break out of that. And that would be very bullish, of course, for the NASDAQ 100. But it, too, is not in a long-term uptrend. Now, gold is both in a near-term, an intermediate term, and a long-term uptrend. It's just green, green, green across the board, uptrend entirely intact. And it's been fighting just below the $2,000 level as I do this podcast. We are bullish on gold, not only in times of chaos, but now that the Federal Reserve is likely to begin cutting rates, or at least pausing for now and not raising them anymore, then the market is now going to begin looking forward to those rate cuts. And that's going to be bullish for gold as well. So the fear and the chaos was bullish for gold, and now the lower rates are also going to serve as a tailwind for gold. As rates go down, the dollar goes down, and therefore things like gold and silver do well in that kind of environment. So gold is really doing well, and silver as well. Now, silver has had a tough time. It's been very volatile, unlike gold tends to be less volatile, of course, but silver's had a wild run over the last several months, especially. But it's also in a long-term uptrend, so that bodes well for silver. Now, we look at silver, and when we look at the charts on silver, we would say that we need to break above 24.50 on the price of silver to really see some momentum, and we're getting close to that. We're getting close to that now. The price has been hovering below that area for a little bit, but we have rebounded sharply from the $20 level where we had sold off. So when it comes to silver, we want to see a breakout above 24.50, and when we're looking at gold, we want to see that breakout. We already got a breakout above 19.50 on gold. That was big, but we want to see it hold the $2,000 level. That's a really key psychological area. Now, a couple of other markets I just want to mention before we wrap this up. The dollar, as I mentioned, remains in a long-term uptrend because it was just bid up so much by the rising interest rates. But now that we're nearing the end of that, and now that we're going to be moving into a pause and then cutting moment for interest rates, that does not bode well for the United States dollar. And we've been telling our members now for some time that we expect that the dollar could test its 2018 lows within 12 to 18 months. And that would put the dollar index back, closer to, say 90, whereas right now, it's trading above 100. So there's major resistance on the U.S. dollar index around 106 to 110. We don't think we're going to get back above that, barring some sort of, some black swan, something that we can't know now. And that could happen. And that could cause a rush to safe havens like the dollar. But barring that, we don't see any upside catalyst for the dollar now. Now we see more downside for the dollar. And again, that's good for anything priced in dollars. Let me talk about a couple of the markets. The Russell 2000. This one, I think, is a potential good setup right now for investors or traders even. So the Russell 2000 tracks, as you might have guessed, the Russell 2000 index. And we track that, by the way, through an ETF that we like to use. And that's what we teach our members about. But what is the Russell 2000? Well, it's an index like the S&P 500 or the NASDAQ 100, but it's focused upon small cap stocks. And small cap stocks, have gotten hammered over the last little bit. The reason is because, these are stocks that historically outperform at the end of a bear market, and they tend to outperform at the beginning of a new bull market. But they also get very skittish in times of fear. So when we had the banking crisis, small caps just, fell off of a cliff because people will sell those stocks before they'll sell their big, large cap stocks, right? So small caps could be a good opportunity this year, in our opinion, as we move forward. That's one that we would be watching closely. I think we could see a nice rebound. In fact, the Russell 2000 is trading just barely off of its October lows. And so that means we could have much more upside if the enthusiasm picks up. So The Russell 2000 is one to watch. It's currently in a long-term downtrend and an intermediate downtrend. It's really, kind of beaten down. That's one that could do well. Oil also way down from its highs. And we don't really see another upside catalyst for oil in the near term. You could see it move back a little bit higher, maybe in 2024, but we just don't see much on that front right now. We've kind of gone through that big rally. Now, with the dollar continuing to fall, that could provide a little bit of an impetus or a catalyst for oil prices, but not to the extent that we saw perhaps in 2022. That was kind of a one-off, in our opinion, for now. We could see more of that in the future, but not now. And then finally, let's also talk about cryptocurrencies. So, Bitcoin, for example, and Ethereum, both of these right now are in great places. So at the beginning of the year, we told our members to expect that the cryptocurrency market would lead the stock market higher in 2023. And we have certainly seen that. I mean, Bitcoin is up more than 50%, year to date. If we look at, say, for example, at Ethereum, what we see year to date is that, it's up 51%. In fact, let me correct myself. I just looked at the numbers. Bitcoin's up 71% year to date, and Ethereum is up 51% year to date. Well, that's really, really good. It's very good to see that kind of movement in cryptos after the brutal 2022 that they suffered. So Bitcoin and Ethereum, we remain very bullish on. That's something that we've been talking about now for over a decade with our members. And we expect much more upside ahead in 2023 and 2024 for cryptocurrencies. Absolutely expect much more upside ahead. So we could go on and talk about more markets and all of this, but this is what we do with our members. And so if you're interested in getting ongoing updates with us, just go to followthemoney.com and learn more about us. Followthemoney.com is where you can learn all about what we do. But we're constantly providing ongoing education, insights, information to all of our members on the topic of these markets and many others. So that's really all the time we have for today's episode. As we've seen, there's lots of uncertainty. There's lots of volatility going on in the financial markets right now, thanks to a variety of economic news and global developments and Federal Reserve talking about this and banking crisis and all of this. But what you need to do as someone who's out there listening to this, the best thing you can do is stay informed, stay focused, and stay focused upon your long-term investment goals. Don't let these short-term market movements alter your entire long-term investment plan, right? You've got to learn to navigate these challenges and find opportunities within them. And obviously, you can take advantage of short-term market movements through trading. That's exactly how we would do it. That's how we do it. But when it comes to your long-term plan, you don't want that to be altered by short-term. In fact, you want to take the short-term volatility and use it for benefit or opportunity for your long-term plan. So, that's really what we wanted to say today on today's podcast episode. I hope you found this episode informative, insightful. I hope it gave you better understanding of the current state of the market. And as always, we welcome your feedback and suggestions for future episodes. If you ever have questions or topics that you'd like for us to cover, please don't hesitate to reach out to us on our website, followthemoney.com, or you can find us on social media. We're on Facebook, we're on Twitter, we're on YouTube. And also, finally, if you found this episode helpful, please consider sharing it with a friend or a colleague who may be interested in our market commentary and learning how to invest or trade. We appreciate your support. We'll be back with another episode very soon. All right, friends. Well, as I had mentioned, I sure hope you enjoyed today's podcast episode. And as always, I like to leave you with a final word, this time from the great investing legend Benjamin Graham, when he said, "In the short run, the market is a voting machine, but in the long run, it's a weighing machine." Now, many people have heard that phrase, but they may not know what it means. It basically means this, that in the short term, the stock market tends to be more influenced by investor emotions and perceptions. Sometimes they're right, sometimes they're wrong. And so therefore it ends up being more like a popularity contest or or what Benjamin Graham calls a voting machine, rather than the actual value of the underlying assets. And this is because investors may react to news or rumors, and this leads to big, sharp price swings and fluctuations that may not really accurately reflect the true value of the companies that are being involved in this. However, in the long run or the long term, the stock market tends to be more influenced by the actual underlying performance of the companies. And so therefore, it's more like a weighing machine in the long term that assesses the real value of the stock. So over time, stock prices tend to align with their real fundamental underlying values instead of being valued simply by the emotions and perceptions that may affect it on any given day. And I think, once again, this quote highlights the importance of developing a long-term investment strategy and not allowing short-term market deviations or market fluctuations to impact your long-term strategy. By all means, if you know how to trade, take advantage of those short-term market fluctuations, but just don't let them impact your long-term investing plan. And that is just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
Contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a